Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today's topic will be dual momentum. Some of you may remember we touched this topic approximately a month ago. We discussed the dual momentum strategy that allocates between physical gold and Bitcoin, the digital gold. We went, deeply into it, and at the end there was interesting trading strategy. Since that time we wrote 2 more articles about the dual momentum, and there is one more extra dual momentum report in Quantpedia, so I would like to touch all of those subjects. I personally very like the dual momentum strategy. The reason for that is because it's relatively simple and it has a lot of advantages. So first, let's get into the first article. So it discussed the dual GTA momentum strategy using broad number of the assets. So instead of just using 2 like Bitcoin and gold in our previous article, here we have heavily diversified portfolio. And once again, we are building the approach for the trading strategy by taking the broad portfolio. In this case, it's 1, 2, 3, 4, 5, 6, 7, 8, 9 assets, and out of those 9 assets we select the winners on a weekly basis. So let's say top 3, and then we check out of those winners which of those are over the moving average or have a positive performance. So how does it work like? So you imagine that you have a portfolio consisting of 9 assets, and 6 of them perform very well, and you pick the 3 that are performing the best on let's say 6-month basis, and you select the 3 of the best performing, and that's your portfolio for the next week.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
Now imagine that the next week you still have, the portfolio of the 9 assets, but out of those you select 3 that are best performing, but actually from those 3 best performing, only 2 of them performed positively, and 1 of them is best performing, but it has negative performance, and it's the third best performing because all of the other assets are negative. So how does it work in this case in the dual momentum? In dual momentum, you have a 3 top performing assets, but you actually pick just 2 of them into your portfolio, and the weights are distributing among the top 3. So what does it mean is that 1/3 of your portfolio will be invested for the cash for the next week. Why we are using the weekly rebalancing strategy for that, not daily and not the monthly? The problem with the daily is that you will have, using the dual momentum, you will have a very high turnover, so you do not want to that. And if you pick the monthly time period, your portfolio is not very active. So you are just rebalancing once in a month. So the weekly is like sweet spot between being too active and being less active. That's not needed in this case. So that's the reason why we select weekly rebalancing. Now, how we can compare the performance of the dual momentum strategy to the benchmark? So when you have the portfolio of 9 assets, or 10, 6, whatever, any number you want, the natural benchmark is the equally weighted portfolio of those assets. If you are not able to beat that equally weighted average, why should we care about some trading strategy? So we can just buy those 9 assets, equally weighted, spread the portfolio equally weighted, and we do not need to trade at all. In this case, for this our portfolio that we have here, we have here equally weighted benchmark. And then the question is, which look-back period should we use? Because this is the most important parameter. So what is the look-back period on which you base your dual momentum? It will be 6 months, so which is approximately 26 weeks. It will be 5 weeks, 6 weeks, 10 weeks, 20 weeks, so very short, longer, 1 year, up to 50 weeks. It depends. However, the robustness of the strategy is shown when, it's not important which parameter you pick. And this is the case for the dual momentum strategies. So, if you have a portfolio and that portfolio is diversified and robust enough, it's really not exactly important, what is the period that you choose. So, here is an example. So we have a benchmark, it's the red one, and all of the parameters except one have the better performance. They usually have the better Sharpe ratio, better Kalman ratio than, the underlying benchmark. And it's the same, if we change the period from the short term to long term, I mean, it's still the same. So I mean, dual momentum strategy in this case, in the case of this portfolio, is very robust, and it really is really not, I mean, such important. I mean, what will be the next period. Then the question is how many assets you will pick. So we have a dual momentum strategy, so we can pick 1 asset, 2 assets, 5 of the best assets. Once again, I mean, the strategy is robust when it is not very important what is the underlying parameter. It's still, I mean, this is the benchmark, and this is once again the case. So I mean, it's not so important. There is, I mean, one case when there is a bigger drawdown, but I mean, the most of the cases, it is the case, I mean, when you pick just one ETF. But I mean, for all the cases, when you pick 2, 3, 4 ETFs, etc., I mean, the gamma ratio is higher, the Sharpe ratio is higher, the maximum drawdown is lower, etc. So I mean, at the end, once again, I mean, the number of assets that you pick into your winning portfolio is not so important. So I mean, in this case, dual momentum is really robust, and this is what we want from the strategy. We want the robust strategy. We want the strategy that is not dependent, I mean, on the one parameter, which is, I mean, over optimized. So what is our recommendation? So at the end, if the strategy is such robust, I mean, it's a good idea to do not just select, I mean, one parameter for the look back period and one parameter for the number of assets you would like to pick into your portfolio, diversified among them. For example, we can select 3 ETFs based on their 10-week momentum and 3 ETFs based on their 25-week momentum, and we will, I mean, give the 50% weight to each sub-strategy. So instead of running one strategy, you run 2, 3, 4 strategies, and you are diversified among different parameters. So you can change how many assets you pick, and I mean, what will be the length of the period. But still, I mean, in the underlying sub-strategies, you are running dual momentum. So what does it mean is that you pick the winners, and then you check whether the winners are over the moving average or have the positive performance. You remove those that do not have, and I mean, you, instead of buying those assets, use the cash for that particular part of your strategy. So I mean, if you are selecting 3 assets and only one is, I mean, 3 of them, you select 3 of the most performing one, but 2 of them are under the moving average or they have negative performance on the selected period, look back period, you, I mean, remove those 2 assets from the portfolio for 1 week and move your money to the cash. So I mean, you are invested just by 43% in this case. And this is one sub-strategy. And you can, I mean, diversify among multiple parameters and multiple assets that you are picking, and you have multiple sub-strategies and you can mix them together. In this case, we mixed 2 of them. And here is the final strategy. The performance is 4% higher than the equally weighted benchmark. Maximum drawdown is 1/3 of the equally weighted benchmark. The standard deviation is approximately the same. So we have Sharpe ratio 0.89 and gamma ratio 0.87, which are, I mean, perfect numbers, great numbers. And the backtest includes the global financial crisis in 2008. So I mean, it's even that. Okay, so this is the active dual momentum. Then we run the same strategy and we try to run it on just the commodity only universe, so commodity sectors. So I mean, was the broad universe, and here we run it on the commodity sectors. So we selected DBA, DBB, DBE, and DBP ETFs. DBA is Deutsche Bank Agriculture, DBB is base metal sector, DBE is energy sector, and DBP is price metal. So we can take the commodity universe and we can split it into 4 subsectors. And once again, I mean, this is the benchmark. These are the commodities. The commodities are, I mean, the great asset if you want to diversify among, I mean, during the inflation period. And right now we are in the inflation period, so we would like to have the commodities in the portfolio. However, I mean, you do not want to have such asset. I mean, take a look on the chart in your portfolio. I mean, it's very volatile, big drawdowns, etc. So I mean, what is the idea? So once again, we can use the dual momentum instead of just holding the commodities in the portfolio. So we can dual momentum commodities on themselves, so we can split commodities into underlying sectors, and then we can run the horse race of different strategies. And I mean, here is how does it look like if we just use the momentum itself. So what does it mean is that we have 4 sectors and we are selecting 2 of the best, and we are, I mean, rotating among the sectors themselves, and the benchmark is equally weighted portfolio of all of the sectors. So this is like whole commodity index. Once again, we see that the momentum itself doesn't help the portfolio. So I mean, we are not able to have a strategy that's better or have a better Sharpe ratio, better gamma ratio than the index themselves. So I mean, in this case, it's not very good idea to just use the momentum. And here is the dual momentum. And if you run the dual momentum, once again, the same pattern emerges as, I mean, in this case, in the multi-asset portfolio. So I mean, here are the commodities. So all of the equity curves have the better performance, have the better Sharpe ratio, better gamma ratio when we are using dual momentum. So we can put commodities into our portfolio. We can put them not passively, we can put them actively with lower drawdowns, better risk ratios, and better control. This is, I mean, the reason why I like the dual momentum strategy. So, I mean, we can get exposure, but that exposure is kept by a risk. So, I mean, this is the goal. And once again, we are very, very robust. So it's not important, I mean, what is the look back period, what is the breadth. So how many ETFs do we select? 1, 2, or 3? From that underlying, once again, we can build some strategy built from sub-strategy, so we can diversify among the parameters. It would be even better. And because, I mean, those dual momentum strategies have those interesting parameters and characteristics. So they usually have better performance, better risk ratios than the, I mean, underlying portfolios. So we decided to create special report into Quantpedia. It's called Dual Momentum. So you can find it in the portfolio analysis. How does it work? You can build any portfolio. Into the portfolio, you can select any number of the assets that you would like to have. You can select, I mean, trading strategies. You can select ETFs. I mean, whatever you want. So you can fill out your portfolio, and once you have an investment portfolio, you can run dual momentum on that portfolio. Dual momentum on a weekly basis, you can check the robustness of the strategy. So you can select your portfolio and you can check out whether the dual momentum makes sense for that particular portfolio. So, I mean, in this case, we can see that the portfolio that I selected, I mean, the longer look-back periods perform better. The benchmark in this case is the red one, so the red line. And we can see that, I mean, for the longer look-back periods, I mean, all of the equity curves are above the benchmark. Sharp ratios are better than the equally weighted portfolio. Gamma ratios are usually better, etc., etc. So, I mean, in this case, it is good to use, I mean, the longer look-back a longer look-back period. And here we can check out the number of the assets. So, I mean, what is the optimal number of the assets to pick out? Then you can, once you are okay and you have an idea, so you can check out the individual dual momentum strategy and compare it to the benchmark. So, I mean, in this case, I'm selecting 2 active assets and I have 25-week period, and I can compare. So on the 25-week period, I have approximately the same drawdown, approximately the same standard deviation. However, I have a significantly higher performance than equally weighted portfolio, which means higher Sharpe ratio, higher Kalman ratio. I mean, the assets that I picked in the portfolio are highly volatile assets, etc., etc. So, I mean, in this case, the dual momentum is not able to decrease the risk, but I mean, it's able to increase the performance because, I mean, there are a lot of volatile assets in the portfolio that I selected. I hope that you liked this video. I mean, it's a little longer than usual. We went through 2 articles. I mentioned one older article. We have, I mean, extra video about that older article about using the dual momentum allocation between physical gold and Bitcoin. If you are interested, you can use our report in Quantpedia Pro. Read articles, check out dual momentum methodology by yourself. I think you will be surprised. I'm not saying that it's the best strategy that ever existed, but I mean, it's a robust and a strong strategy, easy to execute, easy to use for, I mean, a lot of the people. So give it a try. I really recommend it. Thank you very much, and I hope that you will join me in the next video. And do not forget to subscribe to our channel and follow us on our social media channels. Thank you.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.